Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7:43 Mountain Time. Stock market's just opened. It's down 18 handles. Treasury market's selling off again, following through to a pretty sharp sell-off in the wake of a shockingly strong employment report on Friday. First, a very important housekeeping note. This week's note, titled "Productivity Boom: Cyclical or Secular," is outside of the paywall. We urge you all to go to https://ironsidesmacro.substack.com and read the note. We put them out there about once a quarter to give you a sample of what it's like to be a full paid subscriber. So please go have a look at that note. I'll keep these comments relatively succinct because I really do want you to go see that note. So we wrote about the window for a growth scare closing, given that we did have the strong employment report on Friday. We then got into what we called interventionism, the interventionism denouement, or peak interventionism, and we talked about the implications of the election for fiscal policy and monetary policy. We then reviewed the payroll report using a quote from the Scooter Phil Rizzuto, "Holy cow," because it was a pretty shocking report. We then really got into the theme of the note, which is earnings and productivity. Keep in mind all the data that's come out as of late, the upward revision to GDI, which we consider a much better business cycle real-time indicator than GDP. They are supposed to be equivalent to each other over time, but income drives investment, and GDI is a better real-time indicator than GDP, even though we don't get it quite as quickly as we get GDP. Nonetheless, that combined with essentially no growth in total hours worked for the third quarter, with an Atlanta Fed GDP estimate of 2.5%, means we had another strong productivity quarter. So in the note, we got into a debate as to whether what we're seeing in terms of productivity is a cyclical pop related to the great reallocation, all the labor market churn from mid-21 to mid-22, and this idea that workers have finally settled into their job, they're at peak productivity right before they get to the point where we tongue-in-cheek commented they begin with the "hey, this job sucks and so does my boss" kind of thing, and churn picks back up. But that's certainly one possibility. But on the other hand, a broader theme we've been writing about and is critical to how we've been investing is the idea that we're getting accelerated technology innovation adoption that began in 2018 and 2019 when the labor market tightened, and could likely accelerate through the course of this business cycle to a number of different sectors that haven't as of yet participated, like healthcare, like financial services, and the industrial sector, as we go through a manufacturing renaissance and build high-tech manufacturing even in the U.S. So that's a broad theme of the note. We'd like you to go have a look at the note to really see that. Again, other themes is that window for a growth scare related correction is closing. We could certainly get a sell-off after the election if we have, a disputed election like we had in 2000. But generally, elections breed optimism. We tend to get relief rallies after they're done. We then went on to talk about our expected outcome for that election, which is, we don't have strong conviction about this, but we think the most likely outcome is a Trump victory, which would mean total GOP control of all branches, the House, the Senate, and the White House. That will change the outlook for monetary policy in the long run. That wouldn't begin 2026, but it would mean President Trump replacing the Fed chair. I know a lot of mainstream economists think that means a loss of Fed independence. We actually think what's more likely to happen is a much less reliance on the Fed's balance sheet as a tool, and much less influence in longer term, the setting of longer term interest rates. So please go to the note and read our logic in thinking that. And then the fiscal policy outlook is likely to be different. But under both scenarios, we expect a sell-off in the Treasury market that will force some fiscal consolidation later in 2025. The nature of that fiscal consolidation will be different. The mix would be more skewed towards tax hikes were Vice President Harris to win the election than if President Trump wins the election. Again, read the note for details. As far as the payroll report goes, we are cynical about the data, not because anyone messed around with the data or anything like that. It's more a function of seasonal adjustment factors being polluted by the pandemic. And in this case, the labor or the employment to population ratio jumped in the 16 to 24 category, not the prime age category, in the month when students go back to school. A couple of years over the last 5, students didn't go back to school. So we think that that is corrupted, just like it was post the global financial crisis. Again, go to the note, read the details. But the bottom line here is, for us, the most obvious trade coming out of that employment report is to sell treasuries, because although the seasonals are favorable for equities at the end of the year, the traditional equity market Santa Claus rally, they're unfavorable for treasuries. We've had sell-offs in the treasury market for most of the last almost decade of years. So again, the treasury market could be in trouble here. And we like energy stocks because we expect, even in a Trump administration where they're talking about drill, baby, drill, the real implications will be building out energy sector infrastructure, pipelines, LNG export terminals that will actually help profitability in the energy companies. We very much doubt the energy companies would drill themselves into oblivion in a price war with Saudi Arabia, like was the case in mid-2014 through 2016. So that's it for me. Barry Knapp from Ironsides. Again, have a look at that report. Ironsidesmicro.substack.com. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.